Gold and silver sell-offs often feel sudden, but they usually start far away from metals. They begin with a small change in money conditions that many dismiss as background noise. By the time gold reacts, the stress has already moved through banks, funds, and dealers. If you can spot the opening domino early, you stop being shocked by the drop and start planning. This story is not about drama on a chart. It is about the system that forces selling into the open. Think of gold and silver as the visible smoke while the match burns inside credit markets. When cash becomes more valuable than confidence, even safe assets get sold to raise it fast. Gold is a store of value, but in a cash scramble, it becomes instant liquidity for stressed players. Silver is hit even harder because it trades like precious metal and like high beta risk and stress. So what is the domino that keeps showing up before these sell-offs gather speed across markets? It is a tightening in dollar funding, the price of borrowing and rolling short money across the global system. Funding tightens, margin tightens, and the market shifts from choice to obligation quickly. Forced sellers appear, and their selling has nothing to do with the long-term thesis they believed. The market does not ask your opinion when your broker demands cash by a deadline, with no patience. That is why sell-offs look irrational, even when the big picture case remains intact for a while. Watch what happens when rates jump, liquidity drains, or banks become cautious lenders. That shift hits stocks and credit, then leaks into metals through leverage and liquidation. Futures and options can amplify moves because they are built on calm assumptions and stable collateral. When volatility rises, margin rules change, and positions are reduced across the board fast. It is not a moral failure. It is a mechanical response to a new risk environment enforced from every desk. If you want an early warning, listen for the sound of margins tightening beyond metals. Now zoom out and ask a simple question that cuts through headlines, rumors, and hot takes. Who needs dollars right now, and how hard is it becoming to get them without paying up? Corporations, funds, and traders rely on short funding that must be rolled again and again in markets that clear daily. When that funding becomes scarce, they sell what they can sell now, not what they prefer. Gold is liquid, silver is liquid, so they become convenient sources of fast cash and stress. This is why the sell-off can look like a betrayal of the safe haven story you were taught to believe. It is not betrayal. It is the market paying its bills with the most tradable assets in seconds. The next clue is the dollar itself, because a rising dollar often signals funding stress. When the dollar surges, it can reflect demand for dollars, not just domestic strength. Borrowers who owe dollars but earn elsewhere feel the squeeze and scramble to cover. That scramble drains liquidity, and it forces sales and assets held for safety, even when nobody wants to hit the sell button. This is how gold can fall during fear, even while fear is spreading across markets at the same time. Silver usually falls more because it is thinner, more volatile, and sentiment-driven. Now add another piece of the chain, because bond markets can tighten conditions fast. When bonds sell off, yields rise, and financial conditions tighten like a vice, and borrowing costs climb. That tightening hits growth expectations and risk appetite, then feeds back again across every sector. Silver feels that instantly because industry and confidence both live in its price in real time. Gold feels it through real rates, positioning, and the urgency to raise clean cash without debate. Here's where most people misread the sequence and blame a convenient news bite because it feels comforting. They point at a speech or a comment, but the plumbing had already started shifting long before you saw it. The opening domino is rarely a headline. It is a change in conditions beneath price. You can see it in credit spreads widening, repo stress, and funding rates jumping before price reflects it. You can see it when dealers quote less size and markets absorb risk with less ease. You can see it in volatility lifting before the chart breaks, like thunder before rain. When liquidity thins, prices move farther on less volume, and gaps appear with ease. That is why the early sharp red move feels like it came out of nowhere without warning. It did not come from nowhere. It came from a crowded room with limited exits and rising urgency. When everyone needs the same exit, price becomes the only negotiator left, and it bites. Now, let us talk about positioning, because leverage hides in plain sight in metals. Large traders build exposure with futures, and they hedge with options when calm prevails. When calm disappears, those structures unwind, and they unwind fast with no mercy across markets. That unwind can push metals lower even if physical demand at the coin shop looks steady. Physical buyers matter over time, but paper flows set the short-run price with speed. ETF outflows can amplify pressure because redemptions become extra supply to absorb, and they can move the spot price fast. Miners can add fuel when they hedge forward into weakness to protect their cash flow. Speculators may short rallies as they try to regain control of risk and cut exposure. This is why rebounds can look strong, then fail suddenly, like a wave losing its tide. The selling is not an argument. It is a process completing an unwind across portfolios. So how do you use this without pretending you can predict every tick in a noisy market? You focus on signals that precede forced selling, not stories that explain it afterward. Ask whether funding is loosening or tightening across banks, dealers, and money markets. Ask whether the dollar is rising because growth is improving or because stress is rising. Ask whether yields are rising on optimism or on a disorderly sell-off that breaks liquidity. When those answers point to stress, assume metals can be sold simply to raise liquidity. That does not mean the long-term case is broken. It means timing and structure matter. Separate your conviction from your cash management because they obey different rules in stress. During liquidity squeezes, patience beats impulse and preparation beats prediction every time. If you're trading, watch position size and collateral quality because those decide who gets forced when risk limits tighten. If you are investing, use the plumbing signals to pace entries, not to abandon the bigger thesis. As a professor, I teach this as a sequence because markets move in chains, not myths. Tight funding creates forced selling. Forced selling creates lower prices and more fear. Lower prices raise volatility, and higher volatility forces even more de-risking behavior. That loop continues until someone provides liquidity or the demand for cash cools down. Now watch for the moment the loop begins to slow, because that is where turns happen, with momentum chasing behind it. Margins stop rising, volatility stops climbing, and the dollar stops surging on stress. Credit spreads stabilize, and the market starts accepting risk without choking on it. That is when gold and silver shift from being sold for cash to being sought for safety. The same liquidity that crushed them becomes the tailwind that lifts them when it returns. So the real edge is knowing what to watch before the chart looks scary and emotional. The opening domino is the change in funding conditions that turns sellers into forced sellers. If you track that, you stop reacting to noise and start reading the system with calm. Gold and silver are not broken when they fall. They are being used as currency for cash. They are being turned into dollars to satisfy the deepest demand in markets when stress hits. And when that demand eases, the reason to sell fades and the price can recover quickly. If you want to stay ahead, stop asking why the metal moved today and give yourself context before you react. Ask what happened to liquidity and who was forced to sell, and you get ahead of the move instead of chasing damage after it. Cash pressure builds before panic shows itself, so spot the domino early and choose your move while you still have options. Cash pressure builds before panic shows itself, so spot the domino early and choose your move while you still have options. Cash pressure builds before panic shows itself, so spot the domino early and choose your move while you still have options. Cash pressure builds before panic shows itself, so spot the domino early and choose your move while you still have options. Cash pressure builds before panic shows itself, so spot the domino early and choose your move while you still have options. Cash pressure builds before panic shows itself, so spot the domino early and choose your move while you still have options. Cash pressure builds before panic shows itself, so spot the domino early and choose your move while you still have options. Cash pressure builds before panic shows itself, so spot the domino early and choose your move while you still have options. Cash pressure builds before panic shows itself, so spot the domino early and choose your move while you still have options.